We're good.
Okay, so today our topic is health benefits. I think I'm the very last section for this study group. So congratulations everybody on all the hard work you've been doing. Okay, let's see. Okay, so the agenda today is going to be health benefit basics, the taxation of health plans, HSAs, HRAs, and COBRA, employer shared responsibility reporting, and health insurance reporting on Form W-2. And so I know we have 3 days scheduled. We'll probably get this done in about 2. So I'm guessing we'll get about the first 3 done today. So for health benefits basics, just wanted to mention to everybody, I'm sure every single one of you, whether you've really dealt with health benefits at your work or not, we've all dealt with health benefits in one way or another, just in even receiving the health benefits that you receive for yourself and maybe your family members. So the traditional health insurance plans, an employer either purchases an insurance policy from a third-party insurance carrier, or they self-insure and they pay claims to employees and healthcare providers out of their own funds. Self-insured plans, employers pay benefits on their own insurance funds and either administer the plan themselves, or they contract with a third-party administrator to do that for them. There are health maintenance organizations, which are called HMOs, and these provide healthcare services on a prepaid basis with employers contributing to the plan on behalf of employees. It tends to limit members to who they are able to go to. They can only go to HMO doctors and hospitals that are HMO. The traditional is the HMO has a specific healthcare facility or facilities, and the patients have to go there to get their medical services. Individual practice associations, physicians sign up to healthcare groups, and patients have the option of choosing their own physicians among those in the group. There is point of service, which is POS, and this allows covered employees and their dependents to use non-HMO healthcare providers with the inclusion of deductibles and insurance co-payments. There's the Preferred Provider Organization, PPO, a healthcare delivery system giving participants a choice of a higher level of benefits and lower out-of-pocket costs if they use doctors who are part of the PPO network. And state healthcare exchanges. The exchanges established by the Affordable Care Act provide the ability to obtain the economies of scale in obtaining health insurance for that large organizations have. So the taxation of health plans, generally contributions made by an employer to an accident or health insurance plan, providing insurance for employees, their spouses, and dependents are not wages, and they are not subject to federal income, Social Security, Medicare, and federal unemployment taxes. Contributions made by employees from their wages for health insurance must be included in their income for income withholding and employment tax purposes unless the contributions are made through a valid salary reduction plan under Internal Revenue Code Section 125. So the employee choice, wages or insurance. The rules are not clear when an employer, without a Section 125 plan, gives its employees a choice whether to receive a portion of their compensation as wages or to have the amount paid by the employer to a health insurance carrier to cover premiums. The IRS says that these wages are subject to all taxes, but a federal district court stated that salary reductions are not included in income. So needless to say, a company is safe if they have a Section 125 plan and they're giving contributions that way. That way they can ensure that they are not taxable. Not having a plan, it puts it into question and the IRS does see it as taxable. Employer reimbursements. Reimbursements by an employer to employees for salary reduction amounts used to pay for health insurance premiums are excluded from gross income. If the premium payments were instead paid by the employees out of their salaries, any payments by the employer to reimburse the employees for the premium payments will also be excluded. Benefits received by an employee under an accident or a health insurance plan that directly or indirectly reimburses the employee for medical expenses incurred by the employee's spouse, and dependents by paying the employee or the medical care provider are not included in the employee's income. So here we're seeing both the benefits and medical expenses being provided aren't included, and also the health insurance premiums are not included. Medical expenses. Expenses incurred for medicines or drugs may be paid or reimbursed by an employer-provided plan, including a health FSA or an HRA. The exclusion for the reimbursed medical care expenses applies only up to the amount actually spent or incurred by the employee. Any reimbursements in excess of that amount are taxable income to the employee. Adult children coverage. Through the year that an employee child turns 26 years old, they are considered a dependent, and the benefit received should not be included in the employee's taxable income. So that did come about with the ACA. An example of this is Mike's Payroll Services provides healthcare coverage for its employees, their spouses, dependents, and any employee's child who has not attained age 27. For 2020, Mike's Payroll Services provides coverage to Ann and to Ann's son, Russell. Russell will attain age 26 on November 15, 2020. During 2020, Russell is not a full-time student. Russell has never worked for Mike's Payroll Services. Russell is not a dependent of Ann because prior to the close of 2020 taxable year, Russell had attained age 19 and was also not a student who had not attained age 24. However, Russell is a child of Ann with the meaning of the Internal Revenue Code. Accordingly, and because Russell will not attain age 27 during 2020, the healthcare coverage and reimbursements provided to him under the terms of Mike's Payroll Services plan are excludable from Ann's gross income through December 31st, 2020. Russell's coverage will go ahead and continue until November 15th, 2021, but all of the coverage will be taxable to Ann from January 1st, 2021 through November 15th, 2021. So this one to me was a little confusing, so I don't know if you guys find it or not, but just to be clear, really insurance companies and your employer does not have to give adult children coverage after the age of 26. They are required by the ACA to do it to the age of 26. They can choose to do it up until age 27, but as long in the year that they turn age 26, it'll be taxable all that year, or not taxable. The year that they become age 27 is the year that it becomes taxable. So they can give it, but it will become taxable that year. Additional taxation on health plans. Reimbursements exceeding expenses. Any amounts reimbursed in excess of expenses are considered income to the extent that they can be linked to employer-paid premiums. Self-funded health plans does not involve insurance risk and is therefore not insurance, nor does it have the effect of insurance for federal income tax purposes. COBRA premiums. The exclusion for accident and health benefits applies to amounts paid to maintain medical coverage for a current or former employee under the Consolidated Omnibus Budget Reconciliation Act of 1986, COBRA. Domestic partners. Health insurance plan contributions and benefits are included in income if made or received on behalf of an employee's life partner, non-spouse cohabitant, or domestic partner under federal law. Now, on the other hand, same-sex marriages, an employee's spouse in a same-sex marriage recognized by the state who receives benefits provided by the employee's employer will have the value of the benefit excluded from income. So basically, I think what we keep telling everyone here is that it's going to be the employee's spouse, and the employee's dependents that are covered and are excluded from income. If it's another life partner or something else, then at that case, the insurance company and their employer may choose to cover them, but they will have to be taxable income to that employee. Employer paid physical exams. The fair market value of a physical examination paid for by the employer is not excluded from income as a working condition fringe benefit, but it is, however, excluded from income as an employer paid medical care expense. Social Security, Medicare, and FUTA requirements. To exclude employer contributions from employment taxes, Social Security, Medicare, and FUTA, the payments must be made under a plan. So pop quiz. Employees' adult children are covered under their employer's health insurance plan if the children, A, have not attained age 27 by the end of the taxable year, B, are married and or have children themselves, C, have other health insurance care coverage, or D, are dependents according to the IRS. It looks like everybody put it in the chat.
I think so.
Okay. So if you answered A, you are correct, have not attained age 27 by the end of the taxable year. So non-discrimination requirements of ACA. All self-insured arrangements must adhere to the non-discrimination requirements. For purpose of this non-discrimination test, highly compensated employees include the 5 highest paid officers, an owner of more than 10% of the employer's stock, the top paid 25% of employees. In order to be non-discriminatory in terms of eligibility, the self-insured plan must benefit at least 70% of all employees, at least 80% of all employees who are eligible to participate in the plan, if at least 70% of all employees are eligible to participate, or a classification of employees the Secretary of the Treasury finds not to be discriminatory. In terms of benefits, a self-insured plan is non-discriminatory if all benefits provided to highly compensated employees are provided for all other participating employees. If the plan is discriminatory, only those reimbursements and benefits that discriminate in favor of the highly compensated employees are taxable. So taxes for discriminatory reimbursements. If the plan is discriminatory in terms of eligibility, then you will use the formula for the taxable amount. So the formula below is the taxable amount equals the amount paid to the highly compensated employee times all amounts paid to highly compensated employees divided by all amounts paid to employees. Note, if a highly compensated employee receives benefits other employees are not entitled to, then the full value of that benefit is taxable to that highly compensated employee. So here's our example. Green Food has self-insured medical plan. Only the 5 highest paid officers are eligible for the dental benefits, and the plan otherwise fills the eligibility test for non-discrimination regarding its other benefits. During 2020, employee Ann is one of the 5 highest paid officers, and she receives $300 in dental benefits. The other 4 receive a total of $700 in dental benefits. In addition, Ann was reimbursed for $4,500 in medical expenses, a benefit available to all participants in the discriminatory plan. The DFI medical plan paid out a total of $51,000 in medical and dental benefits to all employees in 2020, including $31,000 to the 5 highest paid officers. For 2020, because dental benefits are available only to the 5 highest paid officers, Ann received a taxable dental benefit of $300. In computing the amount of Ann's medical benefit that is taxable, the dental benefits paid by the plan are excluded since they are not available to non-highly compensated employees. Therefore, her taxable income is calculated as follows. It's her $4,500 in medical expenses times the $31,000, which is the total amount for all highly compensated employees for both their medical and dental. We're going to subtract out the dental benefits for Ann of $300 and the dental benefits for the other highly compensated employees for $700 to give you $30,000. And then you will divide that by the total medical and dental benefit paid to all employees, which is $51,000, subtracting out the $1,000 in dental benefits that were only the highly compensated employees, giving you $50,000. So $30,000 divided by $50,000 is 0.6. And you will then times the 0.6 by the $4,500 medical benefits Ann received to give you a medical taxable amount of $2,700. You will then take the $2,700 medical taxable benefits plus the $300 and the dental taxable amount to give you a total of $3,000 that is taxable to Ann. Next is our health savings accounts. These are created by individuals or employers for their employees and in general is tax exempt. Eligible individuals. This is used to supplement a high deductible health plan. So the individuals do have to have a high deductible health plan to have a health savings account. And it's defined as a plan with an annual deductible of over $1,400 for self-only coverage or $2,800 for family coverage. And it has an out-of-pocket expense limit of $6,900 for self-only coverage and $13,800 for family coverage. Contributions not included in income. Both the employer and the employee can contribute to the employee's HSA. All contributions are aggregated for purposes of the maximum annual contribution limit. The maximum annual contribution that can be made to an HSA in 2020 is $3,550 for self-only coverage and $7,100 for family coverage. Individuals age 55 and older can make additional catch-up contributions to an HSA. The additional contribution is $1,000 in all years going forward. Rollovers. Amounts can be rolled over into an HSA from an Archer MSA or from another HSA. Comparability rule. If employer makes contributions to an employee's HSA plan, the employer must make available comparable contributions to all employees with comparable coverage during the same period. So basically that's saying if the employer gives a 2% of the employee's annual salary as a contribution, then that employer has to do that to all employees, that 2% of their annual salaries to all employees with that comparable coverage during that same period of time. Distributions for qualified medical expenses of the individual, spouse, or dependents are excluded from gross income. Qualified medical expenses include expenses for diagnosis, cure, mitigation, treatment, or prevention of disease. Prescription drugs, over-the-counter medicine prescribed by a physician, transportation primarily foreign essential to such care, and qualified long-term care expenses. They also include health insurance premiums for individuals eligible for Medicare and other than premiums for Medigap policies. Reporting requirements. Employer contributions are required to be reported on an employee's Form W-2 in Box 12 with code W. So the health reimbursement arrangement, which is an HRA, is paid for solely by the employer and not provided pursuant to a salary reduction election or under a Section 125 cafeteria plan. Reimburses the employee for medical care expenses incurred by the employee, the spouse, and dependents. And it provides reimbursements up to a maximum dollar amount for the coverage period, with any unused portion of the maximum dollar amount at the end of the coverage period carried forward to increase the maximum reimbursement amount in a subsequent coverage period. So examples below determine if salary reductions are attributed to an HRA or not. Because as you noted above, our first comment is that it's paid for solely by the employer and not provided pursuant to a salary reduction. So the first example, assume an employer offers an HRA and an employee who participates in the HRA must also participate in the corresponding employee-only or family coverage option in a high deductible accident and health plan. If the applicable COBRA premium for the high deductible accident and health coverage would be $2,200 for employee-only coverage and $4,500 for family coverage, if such coverage were offered separately from the HRA. The annual maximum allowable salary reduction in this case would then be $2,200 for employee-only coverage and $4,500 for family coverage in order for the salary reduction to be treated as not attributable to the HRA. If employees, are having a salary reduction more than that, then it would end up being considered as attributed to the HRA. So it has to be that equal amount. The next example, assume an employer offers a reimbursement arrangement plus other specified accident or health coverage with the actual cost of family coverage for the specified accident or health plan being $4,500 and the employee having a choice to reduce salary by $2,500 or $3,500 to fund this coverage. An employee who elects family coverage and the $2,500 salary reduction receives a $1,000 maximum reimbursement amount under the reimbursement arrangement for the coverage period. And an employee who elects family coverage and the $3,500 salary reduction receives a $2,000 maximum reimbursement amount under the reimbursement arrangement for the covered period. In this case, although the maximum allowable salary reduction is not exceeded, a portion of the salary reduction is attributable to the reimbursement arrangement because the increase in salary reduction election is related to a larger maximum reimbursement amount in the reimbursement arrangement for the coverage period. This arrangement is not an HRA and is subject to the Internal Revenue Section 125 rules. So the HRA continued. The HRA and the FSA generally, if coverage is provided both under the HRA and a Section 125 health flexible spending account for the same medical care expenses, amounts available under an HRA must be exhausted before reimbursements may be made from the FSA. HRA may specify a coverage period for a reimbursement amount of less than a year. Social Security, Medicare, and FUTA requirements. Once the existence of a plan is established, the Social Security, Medicare, and FUTA tax exclusion for employer contributions will apply if the plan is set up to benefit employees and their dependents. Payments to the plan by an employer will not be excluded if the plan benefits dependents only. Qualified small employer, HRA. The law allows small employers that do not offer health insurance to their employees to offer a QSERE HRA, a qualified small employer HRA. Be provided on the same terms to all eligible employees. It must be funded solely by the employer. Pay or reimburse employees for medical expenses as defined by the Internal Revenue Code, Section 213D, following proof of coverage. Offer coverage to all employees except employees with less than 90 days of service, employees younger than age 25, part-time and seasonal employees, union employees, and non-resident aliens. The law allows small employers to pay single employees up to $5,250 and families up to $10,600 annually for their medical expenses. These amounts will be adjusted annually for inflation. So pop quiz, I think you got the answer, but health reimbursement arrangements, HRAs, are paid for by A, employers only, B, employees only, C, employers and employees combined, and D, either the employer or the employee, but not both. And if you answered A, you are correct. An HRA is paid for solely by the employer and not provided pursuant to salary reduction election or under a Section 125 plan. The next pop quiz, of the following health plans, which is not considered a health insurance plan? A, health maintenance organization plan. B, traditional health insurance plans. C, preferred provider organization plan. Or D, health reimbursement arrangement plan. And if you answered D, you're correct. Under a traditional health insurance plan, the employer either purchases an insurance policy from a third-party insurance carrier or self-insures and pays claims to employees and healthcare providers from its own fund. Health insurance plans include traditional health insurance plans, HMOs, and PPOs. Okay, so next is COBRA continuation. The Consolidated Omnibus Budget Reconciliation Act, COBRA, of 1985 requires health plan sponsors to provide employees and their beneficiaries with the opportunity to elect continued group health coverage for a given time period should their coverage be lost due to certain qualifying events. The time period for continued group coverage is generally 18 or 36 months, depending on the qualifying event. The continuation coverage must be the same as that provided similarly situated beneficiaries, and qualified beneficiaries entitled to coverage are spouses and/or dependents. So the qualifying events where they can elect COBRA are the death of a covered employee. In that case, the spouse and/or dependents could elect. The covered employee's termination of employment for reasons other than gross misconduct or reduction in hours worked. In that case, the employee, their spouse, and dependents could be qualified to elect COBRA continuation. Divorce or separation of the covered employee. Entitlement of the covered employee to Medicare benefits upon enrolling in the program. A dependent child losing that status. bankruptcy proceedings that cause a retired covered employee or the employee's dependents to lose coverage. Premium requirements. Employee can be required to pay a premium for the continuation coverage of up to 102%. The maximum premium increases to 150% for disabled qualified beneficiaries after the maximum coverage period becomes 29 or 36 months. The first premium payment may not be required earlier than 45 days after the qualified beneficiary elects continuation of coverage. Election and notice provisions. Employees and other qualified beneficiaries who wish to take advantage of continued group health plan coverage must make an election of such coverage. The election period must last for at least 60 days and can begin no earlier than the date on which coverage was terminated. So just to be clear, basically the individual has 60 days to elect coverage. After they elect coverage, they have another 45 days from that election to actually pay their first premium payment. So there could be up to 105 days before that first premium payment has been paid. Penalties for noncompliance. Employers that fail to comply with the COBRA are subject to a tax of $100 per day of noncompliance for each qualified beneficiary. Maximum of $200 per day per family affected by the same qualifying event. So the FMLA COBRA interaction. A synopsis of service conclusions regarding FMLA and COBRA interaction as follows. FMLA leave in itself does not constitute a qualifying event. There is no qualifying event if the employer eliminates group health coverage for a class of employees that would have included a covered employee had that employee not taken FMLA leave. A lapse of coverage under a group health plan during FMLA leave is irrelevant in determining whether a qualifying event has occurred. The right to COBRA continuation coverage cannot be conditioned on the employee's reimbursement of the premiums. And state or local laws requiring group health plan coverage to be maintained for a longer period of time than under the FMLA are disregarded for purposes of determining when a qualifying event occurs under COBRA. So when I went to the payroll source and did the reading on it, I did think a couple of their examples was very helpful as to when FMLA ends and when a qualified event happens to where they could elect COBRA. So the first example basically occurs that the FMLA period ended and the employee does not return to work. If the employee doesn't return to work, that created the qualifying event where a COBRA election could be selected. Now, another example it gave is, the employee is on a 12-week FMLA leave, but after 8 weeks, the employee lets the employer know that they're not returning to work. So after that 8-week point, when they let their employer know they're not returning, that is when the qualifying event occurs, and that is when the employee can elect COBRA going forward. Okay, if it's okay with everybody, I'm going to open it up if you have any questions, but otherwise I think we'll just stop there for today because it's a pretty good stopping point. All the other information is directly related to each other.
I did just want to ask a question. Back on slide 3, when we were talking about the health benefits basics.
Yeah.
The HMO plan, a traditional plan is when the HMO has its own healthcare facility. Is a traditional HMO pretty much for healthcare workers?
I don't think so. I would have to look it up to tell you for sure, but I'm pretty sure Rocky Mountain Health Plans, they are HMOs. So I think it's just HMOs can be set up differently. Either that they have their own facility or facilities and people have to go there, or they do a group of providers. And I know for me, it's been probably 15 years before I was with Rocky Mountain HMO, but they had a group of providers that I could pick from. So those physicians joined the group, and then I could pick out of those physicians what ones to go to.
Okay. Thanks.
Uh-huh. Anybody else?
My only other question would be, for those of you who have taken the CPB, anything that we covered today, would it be good to make sure you review that for the test?
You know, I think when I took it, there was at least a couple of questions regarding the time frame of COBRA, but in perhaps even the FMLA and COBRA combination. But other than that, it was pretty simple with regard to this topic.
And Rebecca, I don't know when you took it, but I mean, I took it so long ago that ACA didn't even exist. So I don't know if they focus anything on that.
You know, I didn't have any questions for ACA on mine. I just took it in June of last year, so last summer. And surprisingly enough, they did not have questions on the ACA. But I don't know if they were thinking, you know, depending on who's in office, whether or not that was going to be a continued ruling, you know, because that's always an issue as well. So,
yeah.
I also took my test a very long time ago. I don't recall anything really about COBRA, but definitely about the taxation and things on items like HRAs, FSAs. So I definitely would make sure, because it builds into your calculations as well. So if somebody says an FSA and you're building a calculation, you have to know that that is a pre-tax deduction. I would say that's what I saw more of.
Thank you, everybody. I was just taking notes. All right. Well, thank you, Kalisha.
Yeah, I'll see you guys tomorrow at 11. It looks like we'll finish it up. I don't even think it'll take the entire period, but it'll be good.
All right. Great.
Well,
Thanks.
thank you guys for joining me.
thanks.
Thanks, Kalisha.